People are taking on more debt than they ever have before. Imagine where we were just a little while ago. It is much worse today. The first thing I want to look at is the big debt. It continues to get bigger. In fact, the second thing is the big changes. If you look around, so much has happened recently. And when we relate this to what's going on with people's retirements, if you look at the unemployment rate, I'm going to show you some wild and wacky things. And the third thing is the big rotation. What's happening in the markets that hasn't happened for quite some time? I've got all of that and more. Let's begin. Take a look at this. Consumer debt in the US surges by a record $40 billion. The jump shows a rise in credit card balances and non-revolving loans. So imagine that's not a mortgage. We know people today are taking out more debt than ever before in terms of mortgages. But you got to remember, this is 17%, 20%, 25% in some cases. People are going to be spending a lot of money just on that interest. Now, that's great for Visa and MasterCard, but not good for the borrower. Total credit jumped $40 billion from the prior month after a revised $16 billion gain in October. On an annualized basis, borrowing increased 11%. The November gain exceeded all estimates in a survey, which had a median projection of $20 billion, so much higher than they expected. Not that that does much in terms of expectations and projections. Balances ballooned. U.S. consumer borrowing posted a record increase on unprecedented card balances. And at the bottom, you can see the change in revolving credit. I'll show you a couple more charts around that. Just looking at the consumer credit, look, surging. I mean, this chart goes back to the 1940s, and we haven't seen anything like this before, measured in many different ways. It is truly extreme. Non-revolving credit, looking at the revolving consumer credit, record high at this time. And that brings me to this, excess savings. What are people doing with their money today? It's unusual, isn't it, to see this period of time through 2020. Oh, yes, people have so much. They were using this excuse of cash sitting on the sidelines. I mean, there were articles being written left, right, and center about that. And yet, it wasn't the case. You know, if I look at all of this information and you start to remove the noise, there isn't much left, let me tell you. Okay, so you could see the historic trend. Okay, that line is there. All right. Now, as we are today, we are below that trend line. After the stimulus ran out, the savings ran out as well. And this is what brings me to the next part. I think it's really important for us to face the music, to see what reality has for us. This is the civilian unemployment rate, the U3 unemployment rate. I mean, okay, we were at 4.2%. The United States had a 4.2% unemployment rate. It is now at 3.9%. You know this indicator is completely and entirely incorrect when it's showing you a 3.9% unemployment rate, knowing what's actually happening. You should be upset every single time they bring this number out. What about the US labor force participation rate? This is when you know things are messed up, because this number was increasing leading up into 2020. We saw that. And then, of course, you had a bunch of layoffs, you had a bunch of people forced to retire, and then it has come up since. Okay, so that started in early 2020 after the big shock, and it has been growing. Okay, we don't know where it's going to be, but we are still down quite a bit. The chart doesn't go back in this one that I pulled up, but we are at many, many years low. I mean, 61.9%. Previous to that, it was 63.4%, perhaps. So it did drop down a bit, and you know that many people were forced out of the workforce. Americans are dreaming of retiring early, expected likelihood of working. And you could see from 2014 up until the present, this number drops. Okay, no matter if it's beyond age 62 or beyond age 67, the number drops. And I think that for the most part, I would just say that people's idea of the future is not always very accurate. How many people, think about how many people have experienced hardship at some point where they think to themselves, when I'm this age, I'm going to retire, we're going to go to Florida, we're going to live the good life. And then maybe, health problem arises themselves or their family member completely disrupts everything. I mean, you hear about that all the time, and hopefully that, isn't in your particular circumstances. I mean, I've heard from so many. But the point is, things happen, things come up, and we need to be prepared. And there are things that we can do. And the reason I mention this here is because you got to look at what's going on with the markets. Maybe you're not interested in that, but your retirement account, it's interested in that. You've got the pension funds, the 401ks, IRAs, different countries with the RRSPs and the supers, and wherever you are, you will be affected by it. Okay, look at this. Aggregate weekly bond and stock return. There was a lot of red this week, but it was nothing crazy yet. Taking a look at it in this manner, we haven't seen anything like this since March 2020. Think about that. I mean, that is quite intense. This is oil. Oil is still surging. I mean, it didn't really make a lot of sense when you see it in relation to the information in the news. Now, did it? So you remember the whole SPR release, the Strategic Petroleum Reserves? Oh, we're going to release that. Didn't really do much at the beginning, but then we saw the price of oil come down. It came down to approximately $64 a barrel. And it's been up and down, but clearly the direction has been back up. Based on, whenever you're watching this, could be around $80 a barrel. So there has been a significant rise. Anyone who bought in at this moment here, you saw that it was oversold. I mean, it was very clear once it got down here, it was oversold. Now some argue it's overbought at this time. Anyway, the point is, it's not responding fundamentally to what we are seeing. And instead, things are out of whack, aren't they? So let's take a look at the next aspect here before we finish off this video. And if you support the channel while you're here, simply hit that thumbs up button. Okay, it's right down there. Just click that one button. I do appreciate that very much. Okay. What's happening right now? If people don't get wise to the information, they're going to fall behind. This is not a one-day rotation. This is talking about stocks. This is the beginning of a potentially a 6 to 12-month rotation from growth to value. That means those who are invested in those high flyers, in those tech stocks, unprofitable tech stocks, things that did real well from 2020 into 2021, could be a big change. The market has made a reassessment of the risk of monetary tightening, and I think the market is now right. Now, that's one person's opinion, but just look at what's going on. The NASDAQ is at the same levels it was at, I think, from September right now, the peak in September. But this is huge. Remember what rising rates or even the threat of rising rates can do to tech stocks. And we have this. Fertilizer prices sagged the most since 2009 in a break for a red hot rally. The green markets index fell 12% on Friday, the most since 2009. But remember where this has gone. It's up, it's down, it's gone crazy, to say the least. Major producers like the Middle East and Egypt are sold out of urea through February and much of Europe remains shut, so those looking for tons will have to search far afield. China, the best option for spare supply, remains out of the market on an export ban that runs until May. This is the thing. If we look at the information we have at hand, you would think this would go straight up, but things get overbought and things come back down. This is what happens with the futures markets. This is what happens, okay? But you as an individual, you can get sick to your stomach on this roller coaster of ups and downs. That's why you got to be paying close attention, but also be aware of when we should be reacting or when we shouldn't be overreacting. Okay. Chip delivery times are on the rise again. Shortages to continue. This goes on. The semiconductors going absolutely ballistic in terms of price, and also the shortages. Meaning, what does that mean? Shortages of cars, shortages of appliances, everything. Everything's got a chip in it these days, and they'll put it in us soon enough. Oops, not allowed to talk about that. Here you can see the semiconductor index, and then to finish it off, Cathie Wood. Cathie Wood's complex jolted after rising yields hammer tech bets. ARK's ETF tumbles in a miserable start to 2022. Down, I think, another, 5% or 10% this year alone already? But regardless, what we're looking at here is a big change. And I think people should be aware of it. I'm not going to go on forever on that. I'm trying to show you what's been happening with individuals, what they've been doing up until now. They've been investing heavily in these tech stocks, and they have been able to pull money out of that should they desire with margin, borrowing from their own accounts. Watch out. Watch the risk there. I'm telling you right now. Okay? That's my message for today. If you appreciate it, hit that thumbs up button. It's right down there. That's all I ask. That's all you gotta do. If you haven't seen this video yet, you definitely want to check it out. So just click it and I'll see you there.